Good morning, everyone. My name is Stefan Goldsmith, and I'm the president of iAccounting Solutions, Inc. First of all, I'd like to thank Ms. Kimberlina McKinney for inviting me here today to present this presentation to you. Hopefully, it'll be beneficial for you as we talk about the best practices for running your law firm and how it relates to tax and business. And there's a lot of hot topics lately, especially with tax reform. So we're going to cover some of those and cover some of the best practices for running a law firm for the solo attorney all the way up to the small member or small partner law firm. So without further ado, we'll go ahead and get started with a brief introduction about who I am and what our company is and what we do. So again, my name is Stefan, and I started iAccounting Solutions because I saw a problem. And the problem being is I'd worked for a couple different CPA firms earlier on in my career and noticed there was a gap in the service that they were offering and what the clients actually needed, because I was the one actually sitting down with the clients across the desk from them, talking to them about their struggles and their problems. And, I had the solutions in my head, and I came to my firm partners and said, hey, is there a function or is there a way for me to communicate this to the clients? They liked the idea, but they didn't, well, we don't have any way to bill for it. And so that got me thinking, and it led me to start iAccounting Solutions, which is a new way. We're more of a modern day accounting firm in that we don't bill by the year. Okay, so our first topic today is more of a macro view, foundational level topic, which is separating business from personal. And this can become a big issue for solo or sole proprietors or even multiple partner firms. And if you've worked in either one of those, chances are you've seen this type of thing happen where you're at the grocery store, you're at some store, and you say, oh, I forgot to transfer money from my business account to my personal, when it's really a personal expense, and you just pull out your business card, use your business card, like that, figure out, I'll sort it out later. Okay, that's not a huge thing within itself, but it creates a lot of problems, even for businesses that are not incorporated. When you're incorporated, you do really have to work hard on maintaining that corporate structure and making sure you don't commingle business and personal funds together. But when you're a solopreneur or you're a solo practitioner, it's a little bit fuzzier. But one of the reasons why you're going to want to keep that business from personal separate, even when you're a solo practitioner, is because when you go to do your reporting, you're going to have business expenses and personal expenses commingled and mixed together. And when you look at your profit and loss report, when you want to see how much net income you're reporting thus far during the year, because you've made more money this year than you have last year, you want to know how much taxes to pay or how much your estimated tax payment you need to pay, it's going to be really hard to know. And so what it does, it makes for clean financial reporting and just keeps things very clean and separate. A couple of key things that you can do to set yourself up for success, to be successful at this, is to keep separate checking accounts. If you have a separate checking account for business expenses and for income, and you use that solely just for business stuff, it makes it a lot easier to track. And it makes it a lot easier to track in accounting software as well. We're going to cover accounting software in just a few minutes. When you do that, you're going to have 2 debit cards in your wallet, and every time you go to the store, you're going to have to make a decision. Is this business or is this personal? And you're going to pull out the appropriate card. Some banks even have different color cards for business and personal. For instance, I bank at B of A, and my personal card is red, and my business card is blue, so it's easy just to grab the right card. You also may have a credit card you may want to use for business. If you do so, make sure you designate that card for business only and don't intermix it with personal transactions. If you do that, it gets really messy, and it gets in reporting and accounting what's business and personal. And then finally, just final points, treat your business like a business. If you're in business to make money, and we all are ultimately, and to create financial freedom for ourselves and our families, you need to treat this like a business. You can't answer your phone with your kids screaming in the background. You need to have a professional phone line, professional email address. Make yourself look bigger than you actually are. It doesn't take a lot to look like a big company. All it takes is a domain for your email, a decent website, a phone system, and all that can be had for probably under $50 a month. Okay, and so those are some points to that will keep you on the right track and set you up for success and keeping your personal out of your business and your business out of your personal. Okay, this brings us to our next point, which is tracking income and expenses. And let me give you an overall reason why it's important to track income and expenses besides doing a tax return at the end of the year and paying tax. Okay. Tracking your income and expenses allows you to make good financial decisions for your company. When you are having a good year, or let's say you're having a bad year, and you need to know how much you've made in income and where your money is actually going, being able to pull up a report, a prop, and that shows you all those different buckets or all those different accounts where things have went is invaluable. You can make really good decisions for your business and really make strategic decisions too, for that matter, and how you're spending your money and see where the trends are and make changes so that you can turn your business around. I've seen small businesses fail because they don't track their income and expenses. I've seen small businesses succeed and blow their goals out of the water because they were tracking income and expenses and being proactive at looking at their financial statements and making decisions. Now, I say proactive, meaning that they were actually ahead of the game and looking at their profit and loss statement and looking at where they were spending the money and how much money was coming in throughout the year so they can manage their tax liability better and also make key decisions to help them grow. Now, key to making this happen and setting up a system is to use something that works for you and is easy to use. Okay. Now, with that being said, you might say, well, Stefan, a paper and pencil is easy to use. Well, it sure is. But when you bring in an accountant or let's say a staff member to help you with your accounting or bookkeeping, that might be a little hard to share with them and might be hard for them to follow. So with that being said, we have enough tools and technology so readily available these days, and that there's no reason why you can't at least use a spreadsheet. But really, I'm going to make a point for using something that's cloud-based. So a cloud-based accounting system is really where you need to be. That's any business, whether you are starting off or whether you are in business for years. If you're not using something that's cloud-based, you really should be. The reason being is that cloud-based systems are generally device agnostic, meaning that you can access them on any device from anywhere in the world with an internet connection. And how valuable would that be? You imagine yourself being on, let's say, a vacation, or let's say you're taking an extended sabbatical for a couple months and you're relaxing on the beach in Costa Rica, but you need to check in on things every once in a while. Guess what? As long as you have an internet connection and a laptop or an iPad or a tablet, you can do that. And you can work with your accountant or other team members virtually or in the cloud per se. So super important, many good reasons to have an income and expense system, to track it, the reason why, and also the way to do it, again, is to use something that's cloud-based. There's software out there that's free, but there's also software that's paid. And we're going to talk about a few systems out there that are free and paid. And I'll tell you kind of the ins and outs of why they're free and why you might want to consider something that's paid. Okay, we put together our top 5 tracking systems here. All of these are cloud-based and can be accessed on most devices out there. We like Xero the best, okay? We've worked with a lot of business owners and even attorneys, and they found that Xero is the easiest to get in and get out and with as few mouse clicks as possible. And that really is what it's all about, folks, is accounting software is one of those necessary evils. It's not really something we'd like to dabble in and play in, right? We want to get business done and get out, and that's it, and spend our time on other things. Especially for you attorneys, you guys want to spend money on cases and spend your time on cases and matters and billable hours and things that are available. Okay. So with that being said, use this list. You can vet them out and check them out on your own time, and you can each one of these are easily Googled, and you can find them pretty easy. They're all pretty easy to find them on the web. Okay. This brings us to our next topic, auto expenses. And as we talk about a few expenses that are hot topics, please take extra special notes. And if you have questions, feel free to email them over or give me a call. Since I'm actually not here live in person today, I'll be happy to answer any of these for you. So let me explain the overall IRS guidance about auto expenses. Okay, so the IRS says you can either deduct your mileage or you can deduct actual expenses. Okay, if in any transaction or expense that pertains to meals and travel and auto, you need to prove a few things. One, the date, the business purpose, the length of the trip or your mileage, and the actual receipt that proves it. Okay. Now, you might say, Stefan, that's pretty good. How do I track that? Well, you can do it in different ways. There's logbooks, okay, but again, we're not doing it the old school way, right? So we're using cloud-based and applications on our mobile devices, okay? So it's really easy when you get a receipt. Simply take out your mobile phone and use a service like Google Drive, Evernote, Dropbox, or even Box, and you just create a folder called receipts and you stick it in there and you upload it right away. And you do that every time you go get gas, every time you purchase something, you need to keep track of a receipt. You do that just automatically. And guess what? If you ever get audited and the IRS says, show me all your receipts, you've got a folder right there to show them all. Plus, a lot of those receipts are on that thermal paper, and that thermal paper fades within a couple months anyway. So after a couple months, it's really no good to you. So there's really no point in keeping paper receipts. Okay, back to keeping track of these expenses. So again, you really utilized and leveraged technology for your benefit in this, okay? On here, there's a couple mobile apps that are listed, Expensify and MileIQ. MileIQ is actually one of our top apps in our picks, and I'll show you a picture of that. But once you have MileIQ set up on your phone, it runs and tracks mileage automatically, right? You don't have to even turn it on, right? So you get in your car and drive back and forth to work or wherever you're going, and at the end of the week, all you do is go open up the app and you tell it, yep, that was business. Nope, that was personal. Yep, that was business. And it tracks your mileage, and you can input a business purpose on it, and you can track the date, and that's enough for the IRS. Okay. Now, again, back to mileage versus expenses. That mileage works great. MileIQ works great for mileage. When we look at expenses, you're looking at gas, you're looking at insurance, repairs, registration, even lease payments. Okay, we're talking about lease versus buy. Lease versus buy. Lease is basically like renting your car, right? So when you lease, or if you pay interest with the lease, you can deduct that as an expense as well. So that's something to consider. When you buy a car, you're purchasing an asset, so you don't get to deduct the payments right away. However, on the asset side, there's a special section the IRS says, it's called Section 179, where they say, okay, you bought this, you can expense it all in the first year, or you can expense most of it this year, and you can expense it the rest over a few years. And that's depreciation. Okay, if you do keep track, if you are deducting expenses, you can deduct depreciation as well. Okay, so again, I'm gonna go back, kind of take a step back for a minute and look at this from a top level view. What do I do? Well, to really know how to deduct your full amount auto expenses, you've got to track both. You got to track how much money you're spending on gas, receipts, repairs, and you've got to track your mileage too. And you've got to see what's more beneficial, because you don't know that for sure until you actually do it. For instance, the amount of distance you drive to and from work or to clients' offices, the type of car that you drive, all those come into play with how much you're going to spend on expenses versus mileage. Okay, so it's really easy to track both at the same time. Okay, let me give you an example. You go put gas in your car, use your business card, right? That's going to be flowed directly to your accounting software, and it's going to be tracked as fuel or auto expenses. Okay, you're also going to have MileIQ running on your mobile app. You're going to track that mileage as well. Okay, you're going to do that for the rest of the year, right? At the end of the year, when it's time to prepare your tax return, you're going to pull up the report from MileIQ, and then you're going to also pull up your profit and loss statement. This is going to show all of your auto expenses listed, and you're going to compare them both, right? And whichever one's greater is the one you're going to take. Now, once you've done that for 1 year, you might have a pretty good idea of what to do from year to year, or if something changes drastically, you can start tracking again. But it's so easy to use something like MileIQ and just use your business debit card or your business credit card for auto and fuel, that I'm a big proponent of just doing it every year, and you just take which one is the best every year, right? So again, just to recap on auto expenses, you have to prove those 4 points the IRS wants you to prove that up here on the screen. Lease versus buy, it depends. You have to run the numbers and do the calculations to see what it costs to lease the car for a period of time versus buy. Okay, that's kind of a complex calculation that I can definitely help you with, or it could be done, but it really is really outside the purview of this. And then you got to track mileage and expenses, and utilize technology where it makes sense. Okay, for this makes a lot of sense. Use something like MileIQ to help track your mileage. Use your business debit card so that you can track your auto expenses, and then you can compare the both and take whichever one is greater. Okay, here I wanted to show you a brief example of the mobile apps. The first one is Expensify, and the second one is MileIQ. You can see how user-friendly they look and appear to be. Expensify is a bit more of a expense reporting app. You can track mileage in it, but you have to put the distance in yourself, or you have to start and stop the GPS on your mobile app in order for it to work. But we really like MileIQ. You can see MileIQ automatically calculated. It knows points, different points where you go to all the time, like your kid's school, your office, and it gives you the mileage, the date, and also the value. And it gives you a running tally on the value. Really, again, really great to use, very intuitive, and super easy to use. And really, MileIQ is probably the surefire winner here in this comparison for tracking mileage. Okay, so moving past our income and expenses and moving more into the proactive approach and managing your firm and your finances is budgets. And budgets is one of those scary words for a lot of people mainly because they don't know how to use it and they don't know how to keep one. Okay, so again, consistency is the key with a budget, and I think we all know that. We just don't do it. Okay, so let me try to break it down and make it into small, digestible steps for you. Okay. Most accounting softwares like Xero, even QuickBooks Online, they have budgets built in. So if you're already paying for one of these accounting softwares, you already have a budget basically built for you. And in fact, they even will pull in the budget numbers for you. So they'll go in and look at your numbers for the previous year, and they'll populate your budget for what those numbers actually were, and you can adjust those up or down depending on what you think you're going to do in the year. And then voila, you have actually a set up budget. Okay. Now, a bit more proactive approach is to actually look at the numbers and do that manually on a month-to-month basis, okay? So if you know you have a busy season, kind of like in the tax world and the accounting world, we have a busy season during tax season, and then generally in the summer months, it may not be quite as busy. We're going to adjust our budget during those months to reflect that level of activity. So if we expect to grow a lot during tax season, or you expect to grow a lot during a certain season, or even throughout the year, you can put those growth numbers in, and the budget software will automatically project that for you, okay? So what you're doing, once you set up a budget, now you have goals to meet, right? So now the goals are really good for nothing unless you review it, okay? The process of reviewing a budget is probably one of the hardest things to do. So what we generally recommend is you set a day and a time aside, either once a month or once every couple months, and you put it on your calendar and you block it out. No other appointments to be scheduled during that time. You don't budge on that. This is your admin time. This is your review time for your firm to spend time on your firm. Okay. And you look at where you came in at, right? You look at your expenses versus your budget, and then you can make decisions. You can say, hey, we hit our goal. Great job, team. Let's go out to dinner and let's celebrate. Or you say, you know, we did not meet our goal. How come? Is it our marketing efforts? Are we not realizing what we thought we'd realize on those? Do we need to do something different? Do we need to change something? Do we need to drop a service? Do we need to pick up a service to help us in some efficiencies? Those are the types of questions you need to be asking when you're looking at your budget and comparing to your goals, okay? And then also the budget is a living document. It's a living, breathing thing, meaning that from month to month it could change. If you come up to April, May, or June and you say, you know what, we're having a really good year. Let's see if we can push that number and then push that threshold a bit and meet a higher goal. Guess what? You can go in and change your budget to reflect those goals. So again, just to recap, a budget is so helpful for business expenses, okay? Use software that you already have. Don't reinvent the wheel. And you've got to, setting up is fairly easy and straightforward. But once you set it up, you've got to review it and you've got to adjust it from month to month or even from every quarter to quarter to make sure it's working for you so that you can meet your goals. When you do so and you're proactive at creating a budget and also meeting your goals, your business is bound to grow and you're bound to meet your goals and create the vision that you first sought out for and when you created your business. Okay, for example, this is a budget variance report from Xero.
And in this, the numbers might be a little small to read, but in this, on the first column, was an actual number, which is the number that actually happened, your amount of sales, your amount of expenses, and then your actually budget amount. And we see on this example that our actual number was $214.18, but our budget was $7,000, so we grossly undershot our budget. So we might need to make some adjustments there. But this report is a prime example of how you can analyze your budget. And Xero does a great job of doing this. QuickBooks Online does a great job as well. And you can easily look at what your year-to-date actual, what your year-to-date budget is, and look at the dollar amount and the variance percentage. And from this report, again, you can look at and make decisions based on what these are doing and where you're coming in on your budget, and if you need to adjust your budget to meet your goals. And if you haven't figured this out yet, I'm a huge proponent of technology and utilizing it where it makes sense for you and your business. But I'll go over a few points again, just to reiterate them. We've already talked about a few of them. But where possible, you want to use technology to automate tasks, right? And these are tasks that you're going to do every day that you do in business, whether it's sending emails, whether it's creating thank you cards, whether it's updating one system when another system is updated. You can create tasks and use systems to help you do that, right? So we have the acronym here, IFTTT, and some of you may be familiar with what that means, but what it means is basically if this, then that, right? So you want a system that if this happens, then you do that, right? And with technology now, with things like Zapier and these third-party systems that connect different apps, you can create these systems where they're fully automated to where you would have been spending hours a week on updating systems and doing different things to where you're only spending maybe 20 minutes, okay? I mean, it's really powerful. Again, I'm a huge proponent of cloud-based systems. Use systems are device agnostic so that you can use any system or any computer or any device that you want. Systems with mobile apps are great because then a lot of times the mobile apps are easier to use and a little more streamlined. And then again, you might ask yourself, how do you check your bank balance? Do you pull out your computer? Do you call the bank? Probably not. Most of those is probably pull up the app on our phone and we check our phone. And that's exactly what you need to get used to when you're using some of the apps for your company. Again, get used to, with these cloud-based apps, get used to something called SaaS, monthly fees. So again, SaaS stands for Software as a Service, meaning that these monthly services cost a monthly fee instead of paying a one-time fee. And the reason why you might want to do that, even though the cost might be a bit higher on an annual basis, is that there's never ever infrastructure for you to upkeep. You always get the latest and greatest version of whatever software you're using, and you can use it on any computer and it's accessible anywhere. All right, so for example, if there's a fire, let's say someone breaks in and steals my laptop, guess what? All my financial data is not on that laptop. It's in the cloud, logged in. I can pick up a new laptop and simply log in, and all my data is right there where I left it, okay? Again, there's a lot of desktop-based software out there, and those are legacy softwares, meaning they're pretty much in the past. If you're a little leery about going to the cloud and you're not sure about security, if you use online banking, all these services use the same technology and security that online banking does. You're going to be pretty safe. Just make sure you have a strong security policy. Make sure you change your passwords. And I've even talked to a few attorneys about password management, and there's some systems that you can use that are actually online password managers that are very safe, very secure. We use them with our clients, and there's never been any data breaches. So with that being said, we'll move past the technology. I think we understand that technology is important to use and to move forward into the future of your business, and move on to the next topic. Okay, practice management, huge. This is probably where we spend most of our time, at least admin time, right, as managing your practice. So getting this right is so key to your success and making sure you're successful in your practice. Really, when we're looking at practice management systems, what we're looking at is basically job management systems, right? We want to be able to track our cases and our matters and other due dates, okay? And we want to be able to track from any device. Again, I'm tooting that cloud-based technology horn again. And we want to be able to follow up on past due invoices. We want to get paid. want it to be easy for our clients to pay us, so whether that's through credit card, PayPal, or ACH. And we want to be able to manage our staff, right? We want to be able to run reports and see how many hours our staff are billing, whether they're making their realization rates, and what they're coming in at, so we can make strategic decisions for our firm and the management of the firm. Okay, now you may not have staff or contractors yet if you're a solo practitioner, but chances are, if you're a sole practitioner and you want to grow, you're going to bring someone like that on pretty soon to help you, because you simply can't do it all yourself. Okay, so again, we're looking at practice management systems. They should be doing all these things, tracking your cases, your matters. It should be cloud-based. You should be able to follow up on who owes you money, who you owe money to. You should be able to use credit card systems, PayPal, ACH, and payroll staff contractors. Okay, now they're in the world of law firms and attorneys and practice management. There's really not a ton out there that are cloud-based. Okay, but we do like one. It's called Clio. It's CLIO, Clio. We like that quite a bit. It does all this for you, and what it does, it integrates into a system to where you can integrate and tie, and I'll talk to your accounting software. They'll talk to other things that you use, and I'm going to show you that here in just a minute. Okay, here we have a nice little flow chart of a typical or a standard automated cloud-based financial and practice management system. And again, we talked a lot about the benefits of being cloud-based, but really we want to look at it as automated right now. Okay, automated meaning things happen on their own without you having to press a button. Okay, so if we look at from the very start, and keep in mind this is a very far out macro view. There's lots going on in between these systems, but we're just giving you an outline, for a basic outline, to show you how it works conceptually. So again, at the very start, you have an attorney or a manager who inputs the case or the matter or the due date into your firm management system, and preferably that would be something like Clio, okay, which is cloud-based. And you handle the case for the matter. The client pays you. You may pay the client. Money goes in and out of the trust bank account down here. And then everything flows from the case or the practice management system or Clio and the trust bank account. Everything flows into your accounting system over here in Xero. And then eventually your staff or accountant, like once a month, goes in and reconciles your accounting software, and it reconciles your trust and does your trust accounting as well and your reconciliations. And everything happens automatic. The only really manual input in this whole system is going to be the attorney or manager's input. So you have one touch there, okay? And there might be a few others here and through there, but basically everything else flows. Everything is automated. Everything happens and is updated. If you update something in Clio, it's going to update in Xero. If you do something or initiate a transaction from your trust bank account, it's going to be updated in your accounting records. If the client pays you, it's going to be updated in your accounting records and in your practice management system. If you need to pay a client, same thing. It's going to be updated in your Clio's, in your practice management system, and your accounting records. Okay, so again, what we're doing and trying to create is an ecosystem of apps that work and talk to each other, so that you don't have to touch it that much and spend that much time in it. A system like this, you may be spending hours on practice management right now. A system like this maybe take you an hour or maybe 2 a week tops. Okay, huge time savings, huge advantage. And there's so much time you can get back and gain back from having a system that's as easy to use as this. Okay, switching gears for just a minute, or moving on to another major pain point for attorneys, which is trust accounting. Some attorneys have this down, some do not, and this is a major thorn on their side. So first of all, let's go over what the California State Bar Rule of Professional Conduct 4-100 talks about. It sets forth minimum standards for trust accounting and what you need to keep as an attorney when you have a trust and you're holding funds that are basically not yours. Okay, you need to show sufficient records, and you need to be able to tell at any point in time how much money belongs to what client. You must also notify the client when you're receiving money or property. And again, no commingling of funds. Again, we talked about commingling of funds earlier on. We talked about keeping business and personal separate. Same rule applies here. No commingling of attorney practice funds with client funds. And continuing on, you also must withdraw money that belongs to you. So if there is money that actually belongs to the firm sitting inside that trust account, that's a big no-no. You also must be able to provide records, of course, to clients and also the state bar. And importantly, you got to keep records up to 5 years. Those records include client ledgers, account journals, reconciliations, and journal of other properties that might have been given to you in trust. One word, and I'll click on the reconciliations. Those really should be happening monthly. At least that's what the state bar sets forth. And really, to keep good accounting records, that's a pretty good rule of thumb. Knowing how much and making sure your records are complete with how much of the money that's sitting in your trust account belongs to what client, and then also making sure it's reconciled against the actual bank account to make sure that what you think you actually have and what the bank thinks you have are the same. Okay, so we've talked about all the things that need to go into trust accounting, and it's quite a bit, and it can be quite a bit to manage and to deal with, especially if you have a rather large trust account. You may have a staff member that handles it pretty well. You may not. You may be the only one person doing it, and maybe you're not doing it at all. Okay, so let's talk about some easy ways you can help automate your trust accounting. Again, we go back to that diagram that we just showed, and it talks about how everything talks to each other and is linked together. Again, those things that we talked about, Xero, Clio, those things will automatically give you what you need for a trust accounting system. They will easily track client allocations, meaning how much money belongs to what client. And you can also keep statements and check images automatically without even logging into your bank account or dealing with paper at all. And there's another app that we can use to help automate that. It all keeps it in the system. Of course, it's online, accessible online. And again, automating your trust accounting can be as simple as 1, 2, 3, right? Or doing a few little things compared to what you're doing now. Now, I've seen some attorneys that have quite the mess on their hands. I would highly recommend, if you don't have a designated day and time that you actually sit down and do this, or a staff member that's in charge of this, maybe talk to an accountant, or maybe talk to someone who specializes in this, like us, for instance, or someone else that you may know that might be good at this, to bring on and actually do this for you, okay? I've seen some penalties come down the line from the state bar for not keeping track and keeping this sorted. Also, if you're ever audited by the state bar for any reason, if your account goes negative, they're going to want to see records and want explanations, okay? So it's super important that you keep your trust accounting straight. Again, throw and apply technology to your trust accounting. It'll make it that much easier. You don't have to do manual spreadsheets. You don't have to do paper and pencil. Use the systems that you already have. If you, again, think back to that cloud-based system that we painted a picture with that chart, the tools in there automatically do that for you, and very easy to do on a regular basis. Okay, so now on to taxes. Everyone likes to talk about taxes, especially this year. It seems like after the recent legislation passed, and now we have some new tax laws in effect for 2018 going forward. All right, so at any rate, there are some major tax pitfalls that you should watch out for. And some of these are fairly elementary, and some of these are not. So we'll try to explain each one. And some talk about advanced tax situations that we really don't have time to cover in this presentation. But if they pique an interest to you, or if they spark something that you'd like to talk about, or some questions that you may have, feel free to contact us. Happy to chat with you on the phone and talk about any of these that come up. But at any rate, some of the most basic things we just don't do, right? Like not keeping good business records, not keeping copies of tax returns, of bank statements, of receipts. All those things are business records, right? We can automate those again with something like HubDoc that automatically connects to the cloud and pulls all that stuff into one place for us. But we have to actually do it. Again, keeping receipts, we've got to keep those. Really, the best way to do that is to scan using your mobile phone and uploading to some kind of centralized document management system like Drive, Evernote, or Dropbox or Box. Home office deductions is another big one now. It used to be the thought and the rule that if you took a home office deduction, that was a red flag to the IRS. It is not. It's perfectly legal. Nothing wrong with it, but you do need to make sure you have substantiation for anything that you're claiming. Again, and then the IRS recently came out with something called Safe Harbor for home office deductions, where instead of providing records of how much in utilities you spent throughout the year, you basically measure your home office space and you prove that you have that, and you get $5 per square foot of business use, right? So if you have 100 square feet as a home office, then you get a $500 deduction. So it's very easy. There's no requirements as far as keeping utility records. So if you don't have those, there's another way to do it. It's actually been very beneficial for some clients who don't have those records. We've seen a lot of people utilize that. Reported income is another one. Now you might think, well, what's the pitfall in that? Okay, well, we've run into countless situations where folks get paid, or maybe they're not keeping very good, accurate records for their income and expenses, and they report their income, right? And we file a tax return, and all of a sudden they get a 1099 for someone they, quote unquote, forgot about. Okay, that happens a lot, and I've seen it happens with attorneys. I've seen it happen with other business owners. So reporting income and keeping that straight and making sure you're keeping track of every piece of information as far as income and expenses is another apple in the basket for having a good accounting system. Deducting medical expenses. Now we're used to looking at those and saying, okay, well, if we only itemize, then we can deduct those. Not quite. If you run as a sole proprietorship, there is a way to use a section in the tax code called Section 105, where you can actually hire a spouse to come and do some work for your company and for your business, and what you do, you pay them in medical, basically, benefits and expenses. Now, it has to be bona fide and it has to be a real position. You have to fill out expense reports to keep track of that. But if you do that and you have enough medical expenses in your family, then you can essentially write off the medical expenses as business deductions, which is a much better benefit than reporting it on your Schedule A. Okay, and then a big one, which we're going to talk about more in just a few minutes, is sole proprietor versus corp versus LLC, or for you attorneys, that might be sole proprietor versus a PC or versus an LLP. Okay, and we're going to talk about that next. Based off the last bullet point of the last slide, which talked about the tax differences and the pitfalls between a sole proprietor, a PC, and an LLP, I created this flow chart and this graphic to help us better understand and look at this, and also listed some pros and cons to each one so we could talk through. And then I have a conversation about what the natural progression of your business entity should look like. So we'll start with sole proprietor, and which is often what most folks who start out on their own or even start out with a few partners may do. So as a sole proprietor, it's definitely a money-saving way to start business, meaning there's no extra tax returns to file. It's less complicated to operate. There's no corporate demands as far as separation and commingling things for the corporation matters, for that matter. But it is pricey. There is something called self-employment tax that's charged. And self-employment tax is basically right around 15% on the net income of your self-employed earnings, right? So if you have $50,000 of net income at the end of the year, that's your gross, your income minus all your expenses and whatever's left over, that's your net income. That net income number is what gets taxed. I call that kind of the magic tax number, okay? So it makes a lot of sense to be a sole proprietor and starting out. It's just easier to do, easier to operate. And really up until you make about $30,000 in net income, and then it becomes worth it by that time because you're paying enough self-employment tax to warrant looking at maybe going to a PC or an LLP. Now, depending on what your situation is, and there might be other factors that help you determine whether to make that move faster or slower. Okay, for instance, an LLP is great for if you have partners or investors, or if you need to report income or loss disproportionate to ownership percentages to the partners, meaning that if a partner owns 50% of the practice, but really wants to only income and loss to be reported 25% of that to him, you can do that in an LLP. Okay, not in a PC or a corporation. Okay, corporations are great for saving taxes. Lots of tax saving strategies with a PC, taxes, and S corp. But there are some pitfalls you need to watch out for. If you're an owner or shareholder of an S corp, PC, taxes, and S corp, you do need to pay yourself wages. You can take what are called shareholder dividends, which are not taxed on the payroll side. They are taxed on the ordinary income tax side, but not there's no payroll taxes. And best of all, there's no self-employment tax on PC, taxes, and S corp. LLP, there is self-employment tax still on those, and it's a bit more complicated. But generally speaking, a progression from a sole proprietor moving with no partners, moving up and wanting to go to the next step, generally, unless there's a partner involved, generally we'll go the PC, taxes, and S corp route. That you generally offers the most tax savings. Out of saying all of this, everyone's situation is a little bit different. Okay, so what I would generally recommend is that you talk to a tax professional and you have them do a tax projection or a tax analysis for you, right, to see where you fit. And generally that threshold, that mark where you want to start thinking about doing a tax analysis or looking at these other entities, number one is if you hit close to 30K of net income, or if you bring on a partner, or if you are getting into something where you need the protection and from the corporation. Okay, so making that determination from when you move to a sole proprietor to an LLP or a PC, taxes is huge. We always have to worry about taxes, and that's on everyone's mind. So let's talk about taxes for a minute, right? So self-employment tax, which you get charged if you're a sole proprietor or an LLP, right? That's 15% on your self-employment earnings on top of your ordinary income tax rate, okay? If your tax is a PC, but you do not elect S status, meaning that you don't elect to be as an S corp, just a regular simple PC, you can be taxed up to 39% on those profits, and that depends on what the net income of the company. And that's even more expensive because not only is the company taxed, but only any dividends or wages that are paid out to the shareholders, those are also taxed again, and that's called double taxation, right? That's what that means. Very pricey. Pass-through entity tax. So if you are a pass-through entity, which is either an LLP or a PC, tax as an S corp, there's no corporate level taxes. Okay, so there's no taxes charged directly to the LLP or the PC on the federal side, from the IRS. Okay, but instead those get passed through to the shareholders and get taxed at the shareholders' tax rates. Okay, so even if you get reported, if you have an LLP or a PC and you have $50,000 of net income, or the company makes $50,000 of income that gets reported, that gets passed through directly to you, and you as a shareholder or a member or partner pay tax on $50,000. And that's no matter if you receive $50,000 in cash or not. That's the profits of the corporation being taxed. Okay, so you're going to pay tax on that whether you receive that cash upfront or not. Okay, and in California we have something called franchise tax that we need to worry about. In fact, most states have franchise tax, but ours is particularly high. It's 1.5% of net income with a minimum of $800. Okay, so a lot of you may have heard about this minimum $800 tax. It's pretty pricey. Everyone's afraid of it. It's basically just a cost of doing business in California, and that's charged by the Franchise Tax Board. And that's something to watch out for if you're an LLP or a PC, right? That franchise tax does not apply to sole proprietors, but it does apply to LLPs and PCs, okay? And then, of course, we have to consider filing tax returns and the cost of compliance. As a sole proprietor, it's pretty cheap. You don't really do anything except file an extra form on your personal tax return. But as for an LLP or a PC, it requires a whole other tax return done for the corporation. And so there's considerations there when you're when you open up or start an LLP or a PC, that you're going to have an extra tax return to file with your accountant. You also have some corporate compliance issues with a PC. You need to keep minutes. You need to draw up resolutions and keep records that way as well. Okay, so again, just to recap, because this is such a hot topic, this is also a very complex matter that is handled usually on a case-to-case basis. So if you think you're ready to move from a sole proprietor to an LLP or PC, you really ought to do some good analysis to make sure that's the right move for you. And talk to your accountant, do a tax projection, have him spend a little bit of money with them and have him help you through that process. So again, just to recap, sole proprietor versus LLP, you do have self-employment taxes, but they're a bit easier to manage. The LLP offers greater flexibility in how you report income and losses to partners. A PC, taxes and S Corp, requires a bit more complication, but there's no self-employment tax. And you can have partners in a PC as well, but they're called shareholders. And however many shares they hold or percentage of shares they hold is what they get reported as income and loss to them. Either way, a pass-through entity, you're going to pay tax on the profits or not if there's a loss, and that gets passed directly to the partners or the shareholders. So again, sole proprietor makes a lot of sense for people just starting out up until about $30,000 of net income. Once you hit that $30,000 of net income, that threshold, it's time to start looking at an LLP or PC, and you may want to start looking at an LLP or PC before $30,000 if you need some further legal protection and you just need a separate need an additional barrier between your business and your personal assets. And that wraps up our presentation today and brings us to our conclusion. So thank you for attending. Realize there's a lot of information that we covered in those slides. So if you have any questions or your interest is piqued, please feel free to reach out to us via email or phone, and we're happy to help you and talk to you further. Again, if I could give one word of wisdom, if you're starting out or if you are in practice, if you want to make change, it just starts with one thing, right? And if you need help with that, give us a call. Happy to help you figure what that is and help you along that journey. All right. Thank you again for coming, and hope you have a great day.